Hi, this is Thomas Feng with Bay Area Connect. This week we're joined again by Joe Lima of Princeton Capital. Today we're talking about some real estate news. Something that's been really hot in the market has been refinances. Freddie Mac has just reported to us that 22% of those doing refinances are paying down their principal. They're doing a cash-in refinance to pay down the principal and get a better interest rate and also possibly change the terms. So Joe, why would a homeowner do a refinance?
Well, Thomas, the number one reason why someone's going to look to do a refinance would be to lower their monthly mortgage payment. With current interest rates where they're at, around 4.5%, someone's going to definitely see some savings because these are the lowest rates we've had in 50 years. So for example, if someone purchased their home a couple years ago, they are at 6% on their mortgage. That's determining their monthly mortgage payment. They look now at current market levels of interest rates, they're going to definitely save some interest, which is going to in turn save them on their monthly payment, just right off the bat from switching interest rates. Another reason would be that someone is looking to either extend or lower their term on their mortgage, where they're currently at a 30-year and they want to knock down their interest rate as well as knocking down their term on their mortgage to a 20 or a 15-year, or the opposite, where someone has a 15-year and wants to stretch out their mortgage payment over time to have a lower monthly payment, so they go from a 15 to a 30. A third common reason for refinance would be someone currently has an adjustable or a short-term fixed loan where the loan rate is fixed for 3 or 5 or 7 years, and it's now becoming adjustable, and they want to make sure that they have the stability of a long-term fix. So they are going to lock in their interest rate and refinance into that 30-year fix program.
Thanks a lot, Joe. It sounds like for homeowners there's various reasons why you would get a refinance. Obviously the one we've hit on the most is definitely interest rates. 2-3 years ago the average interest rate was at about 6%, and we're currently at about a 4.5%. So that would be the most obvious reason right off the bat. So Joe, you've been doing loans for a while. Why don't you take us through the whole refinance process?
Well, in a nutshell, the refinance process is going to be very similar to your purchase loan process, minus the purchase contract and the upfront, termite inspections and things of that nature. What it is going to entail is income documentation to make sure that the borrower does qualify to the current income guidelines that are necessary. No matter if the borrower has been perfect on their payments for 4 or 5, 10 years, we still have to make sure that the ratios still hit that aspect. Credit report will be taken and reviewed as well to make sure that the borrower does qualify there. And also an appraisal will need to be done to determine the value of the property. This is the number one hurdle that needs to be dealt with in today's refinance market. Mainly because the banks nowadays want to make sure that there's enough equity in the property to make it less of a risk for them to do the new refinance, to have the new loan. Typically today the house needs to be at an 80% loan to value with 20% equity. So for example, if someone has their house appraised, it comes in at $500,000, the borrower's new loan is going to be $400,000. There's at an 80% loan to value, so there's enough equity to make the refinance work.
Well, it sounds like the refinance is pretty much just a regular loan. So the homeowner should be prepared for about a 30-day process. It is just like a regular loan. You do need to get an appraisal to figure out the equity of the home. Like Joe has talked about a couple years ago, the most important thing when making a loan is credit. Now it's definitely equity. The banks want to see that you have equity in your home. Versus before, they were expecting growth, appreciation, so they were more looking just at credit. So now we talked about why a homeowner would get a refinance, how to do one. But Joe, why don't you tell us a little bit about cash-in refinances? Why are those so hot right now?
Yeah, if you asked me that question a couple of years ago, most people were doing cash-out refinances, where they're taking equity out of their home to pay off some credit card debt, maybe do some remodeling, that type of thing. With today's lending market and strict cash-out guidelines, a lot of people have turned into the cash-in refinances just to save their monthly payment. And equity being where it is right now, it's a little bit more difficult in order to get those cash-out loans. But with the cash-in refinances, there's two main reasons why someone would want to do that. The first would be the loan-to-value ratio, like we talked about before. Let's say their loan-to-value ratio came in at 82%, and the key threshold is 80%. that borrower may pay that extra 2% down on their current loan balance in order to qualify for that new refinance, because over the long run they're going to save a lot more money on a monthly basis and over the life of the loan with the interest by getting that rate from a 6% down to a 4.5%. They're just going to see that savings there. So paying that upfront 2% or 3 or 5%, whatever it may be, to qualify them is going to definitely help them. Second reason why someone would be doing this nowadays as far as the cash in refinance is the way the lending guidelines are set up as far as loan amounts. Typically, the first loan amount would be up to $417,000, and that's called a conforming loan. That loan is going to have the lowest interest rates that are going to be around because of the guidelines it's set. A second tier loan is going to be anything from $417,001 all the way up to $729,750. Those are called an agency jumbo loan. Those are going to have the second best rates available. And then the third and the heaviest risk loans are the true jumbo loans. So that's anything above $729,750. Those are going to have the highest rates. So if someone is going to refinance and they're right on the threshold between one of those tiers, let's just say, for example, they're at $420,000 for their new loan amount. That borrower is going to more than likely come in with that extra $3,000, get their loan at $417,000, and have that lower interest rate, because again, over the life of the loan, it's going to come back and that investment will be paid back to them.
Thanks a lot. So cash in refinances are really hot right now, pretty much for borrowers at the threshold. The first reason Joe talked about is just paying down your loan to debt ratio. So loan to debt ratio, pretty much if you're under 20%, you're going to be paying mortgage insurance. So right off the bat, paying that off to get to that threshold will definitely help you out. And then there's 3 tiers for loan amounts. So once you break that tier, you're automatically at a higher percentage. So if you can pay that $10,000 or $5,000 just to get to that level, that will save you in the long run.
And that's the most common too, because they're going to be each time you move up in tier for loan amount, you're going to be looking at a difference between 1/4 to 3/8 of an interest rate. Mm-hmm. So for someone to come in with that extra money, it's going to definitely help them out for the monthly payment. Right.
So Joe, now we talked about how the market is today. What about a couple years back? How do you see changes in the refinance process?
Well, and as far as a couple years ago, like I said, cash out refinance was the main thing that was going on as far as refinance goes. Today, people are more conservative and they're looking at paying down their debt, their mortgage, as soon as possible. So getting a new interest rate, you may lower your monthly payment, but it also helps accelerate and get your loan paid off sooner by paying the same mortgage payment that you were paying before, but having that money go directly to principal. As far as qualifying purposes go, it was a lot more lax, obviously, a couple of years ago, where maybe you only needed was a credit report because income guidelines were different then. Today, you're gonna, like I said earlier, you're gonna have to make sure that your income ratios fit Fannie Mae and Freddie Mac guidelines. You have that appraisal done with the amount of equity that's needed, and that your credit is pretty much flawless and good to go.
Awesome, Joe. Well, that ends our video for today. We're going to touch on something that we'll be reporting about this coming Thursday. The California tax credit for first-time home buyers is coming up. Applications will be due by this Sunday, August 15th at midnight. So on Thursday, we're going to be talking about the California tax credit, and that's up to $10,000 for first-time home buyers. And we'll be telling you about where to get the application, how to fill out the application, and things of that nature. If you have any questions or comments about this video, please connect with us at facebook.com/Bay Area Connect. I think that's it for this week, Joe.
Yep.
Have a good one.